She gave one to them. Good morning. You on your own today? Where do you work? Okay. Do you have a sister who works at Attorney General's office? Boy, listen. The lady who's attorney? Look at her sister. Wow. Look at her sister. Did you get to do the, you had done all the homework? Up to the, for the chapters covering the midterm?
Yeah, so we have some kind of thing.
Yeah, it's
We're gonna be
15
at
and
the second one.
15 and, cause I
and
posted all the
15.
solutions, right?
You did?
Yeah.
No, I didn't.
I
I
posted the
submitted those
solutions, I think, a week ago, when we were
Really?
supposed to have the review, yeah.
And the review is still a good there. I was waiting on that.
No, we didn't do it.
No?
No, I didn't do it. I had jury duty and I was insane, so so I said I'll do some review today,
Oh.
and then I put the midterm for, that's I put a message to do it for next Saturday, because that jury thing, that just threw me right off. So I had posted the solutions. And I attached the solutions in a message, the last message I did on February 20th.
Yeah, I forgot.
You see it? Yeah, because I want a person to look at it, because I know I didn't get to, I wouldn't have gotten to deal with the reviews. So I'm going to,
Did you give chapter 17 assignment and top?
I didn't do an assignment. I told persons that I posted some so that you could go over those questions. I think I posted some for that. Because I wanted to go over some of that, but for that chapter, my focus was gonna be more theory. Right, because it's more important, so last class, I didn't really do any questions, so these were gonna be the ones I go over as questions. Because for chapter 17 investments, the big piece there is the equity method. Right, and where we recognize a proportion of their income, so the questions there, kind of focus on that. That's why I picked that one. So you go from being an investor that's less than 20%. Then when you go, then you have an investment between 20 and 50, and then over 50 is just consolidation. So you have to know what to do in each scenario. So like when you look at chapter 17, the questions I have there, these are the ones I'm gonna go over. smaller because, that's my focus for that chapter. I need to join this meeting too, so I could share the screen for questions. What do I do that? Okay. So for chapter 15, with any questions, because this is a review part I can deal with first. Any questions on chapter 15? Everyone was good there. So 15, just as a reminder, chapter 15 dealt with equity, right? Equity section. So the things that the takeaways are know how to record equity. So if I get equity for cash, for land, if I perform services, someone performs services and they get stock. So that's the first leg that you should know. Then we talked about treasury. So when we buy it back, what happens? How do we buy it back? Then we talked about disclosure in the equity section. So how do we disclose? So you had a question 15, 17, and the focus of that was disclosure. So the big thing there to keep in mind for disclosure, all those little pieces like $4 cumulative, par value, authorized, issued and outstanding in the descriptor are very important when you are doing disclosure for equity method, right? So you need to know that where everything goes. So first we have capital stock, then additional paid in capital, retained earnings, we less treasury, and then we get to total stockholders equity. So they were the big chunks. So like I said, when I do exams, I take it from the questions you already have. So you feel comfortable, you're good to go.
I just have one thing I wanted to go over with chapter 15.
Okay,
It would have been the final homework assigned after.
so from that chapter, you had one problem and the rest were exercises.
But the equity would be.
Which number?
That's 15.17.
Okay,
I mean, I did it, but I don't know if I don't know how I did it.
okay, so 15, 17 is the question with disclosure, right? So when we do the solution for that one, right? So we have Roanoke Core. And the thing that I want you to keep in mind for this one is that when you get questions like these, you get a whole bunch of information, but you don't need all of it. So that's the first thing. Sometimes people see it and it throws them off because I have all this information, because they want you to pick out what's important. So that's the first level of throwing people off, just having a bunch of information. So the first thing that you need to keep in mind, so this is point, right? You're doing an exam. This other thing I say, first have the big bucket. So the big bucket is capital stock, additional paid in capital, retained earnings, and less treasury. And then we get a total at the bottom, total stockholders equity. Okay, so when you do a question like this is what you should do first. So if you ask to do a stockholders equity section, you set the framework, because this is what should be there, right? And so you have a long piece of paper, you put the big buckets, enough space between each one so you could fill it in. So each one of these is a point, right? There's some more points on this side than this side. So sometimes people focus on numbers, but when we do stockholders equity, this side is actually the bigger chunk, because you got all the little pieces going on over here, right? So we have these sections, so if I have it set up like this, then I know I should be looking for different things in each section. Okay, so the top section, the thing that I should be looking for here is preferred stock. So I should, and common stock. So if you look at your question, do your preferred stock?
Yeah.
Okay, do you have common stock? Okay, so we know we have those two, right? So when we have preferred stock, there's certain things we must disclose. We must disclose the value for how much we can have to pay them in terms of dividend, right? And whether they're cumulative or non-cumulative. So what do we have there? What do they tell us?
They're gonna have to pay us $4.
Okay, so this is the first piece of information we have here. $4 cumulative. Then we have to indicate whether it's par or no par, what is it? So does it have a par value?
Didn't state it.
Look in the question, does it tell you a par value? Look through the whole thing. It should have a par value, because that's what you're gonna,
$50 par.
okay, so we need that. So par value $50 per share. The next thing we need to know is authorized. We need to know issued. And we need to know outstanding. And this is a number. So how many authorized?
60,000.
How many issued?
10,000.
And how many outstanding?
10,000.
Okay, so we could just put an "and" here and just say 10,000 shares. What's the value of those shares? They give you a trial balance, because they give you a value. Look on your numbers. It should give you a total value for your preferred shares.
500,000.
Okay, so now we finish with preferred shares. Right, so common stock. We follow the same pattern. So common stock are not gonna have cumulative or any fixed dividend, right? So we could just jump to the par. So are you gonna have par or stated value? So what's the par value here?
The dollar par value.
We're gonna need to know what is authorized, issued, outstanding. What's authorized?
600,000.
600,000 shares?
Yes.
Okay. How many are issued?
200,000.
And how many outstanding?
190.
Okay. And what's the value of that?
200,000.
All right. So we know that we have 200,000 issued, but only 190 outstanding, so that 10,000 is what? This would be the bought back. So we issue it to the public 200, but we only have 190 outstanding. So there's a difference here. So what is that difference? What does that represent? That represents what we bought back. So when we buy back shares, what is that? Okay. So that goes there. Okay, so that makes us whole. So we have 200,000 issued, 190 outstanding, and that difference should be treasury. Okay? Because these are shares that we bought back. We don't pay dividends on treasury shares. Right? We only can pay dividends on what's outstanding.
Okay.
Right? So this way we show it. They never go back to authorized. That's a fixed number. This issued amount, once we issue it, is issued. So this is the number that's gonna fluctuate what's outstanding, whether we have treasury or not. So every time we buy treasury shares, the amount outstanding is gonna reduce. Okay? You see that? All right. So we finished with the preferred, we finished with common stock, so at this point, we could do a subtotal.
I think that's why I was confused, that $10,000.
Okay. So you got it there? All right. So here, we're gonna have our subtotal. Right, and then we got total capital stock. So everything above this line is par, right? This additional paid in is whatever we paid in excess. On these stock, on treasury, but this any excess, right? So they tell us some excess that happened. So what's the first one? We did any in excess on common?
And access of par common, 1.3.
Anything else?
The single treasury stock.
Okay, so that's all paid in. So we get 1460123. So now we have total paid in capital. Which are these two numbers. So this is the total paid in capital paid in that it was at par and then any excess. So this is the total capital that was paid in the business. This is everything that we put in, right? As the owners. So let's look at earnings now that we have earned over time, our retained earnings. Do they give that to us?
Yeah, return earnings is 301,000.
Okay. So we got that there, so we add that in. And then the last thing, we have the last treasury stock. 10,000 shares, and this was, they tell us treasury stock was valued at cost. How much is that one?
On 17.
Okay, so there's a subtract. Right, Treasury says what we buy back, so this is always a debit. Everything else here is credit. And so when we take that out, we should get our total stockholders' equity of 2291. $2,291,000. So this is our stockholders' equity section. So this over here has more points. Each one of these things is a point to get it right. Okay? So you good with that one? No? Yeah. Anything else on chapter 15? Okay. So chapter 16. We got into securities that were convertible. So if we had bonds on our books and we decided to convert them to stock. We had our entries, we looked at to do that. We also had preferred shares if we wanted to convert those to common stock. And then we had compensation. So if someone had income, sorry, we had staff and we gave them stock. That also was something that was looked at there. The last thing on that was the earnings per share. So there's a formula for earnings per share and there's one for diluted earnings per share. So like I said, I want you to know what the formula is, because if you get that in a multiple choice, you should know what the difference between the earnings per share basic and then the diluted earnings per share. So 17, like I said, I put some questions because I'm going to go over a couple of concepts just to do a little bit of review on that chapter. Let me go to, I need my laptop for this one. No, I don't, okay. Great. So chapter 17, we talked about chapter 17 last week. And chapter 17 covers investments. Go to 17. So the big thing here in terms of investments is that these are investments that are on your asset side. So you are investing, you have excess cash or funds available, so you're doing investments. And we talked about the tiers. So if you have the little table. So the big thing here is if we could invest in bonds. Right, we could invest in equities. And we could invest in derivatives. So you can read all the theory around that. So these investments. These on the asset side. Okay, and they'll be under this big bucket on your asset side investments. And we honed in on this one here, because that's really new. This I just wanted you to understand what that is. I'm not getting into any questions on derivatives. This, you would have talked about bonds before, bond discount, bond premium, but it's just, now this is an investment. You have a company and you are investing in bonds. Okay, you're not issuing bonds, you're purchasing them as an investment to make money. So on the equity side, what we said last time, there are the considerations you have here is how much you hold. And then how do we value and record? What method? Okay. So if we hold less than 20%, we don't have any influence in this company, then we use the fair value method. So that's choice one. Choice two is if we hold between 20 to 50%, we have some influence. Then we use the equity method. Okay. And then the last one, if we own more than 50% and we have influence that's significant, so significant means that I have people on the board, they have contracts with significant contracts between my company and their company. I produce shoes, they produce rubber for my shoes, they're a significant supplier. We share management staff, all those things could indicate significant influence. And we own more than 50% of the shares. This is share ownership. Okay. Then we do consolidation. And consolidation is where their financial statements, my financial statements, we combine them together. So we just show one financial statement for all the entities where I have 50%. So that's all we said about that. That would be consolidation. Consolidation is a class by itself. Okay. So that's the one. You would have done this before in previous accounting classes where you invest in a security. The price is $10. You sell it in 3 months for $20. You recognize the gain, right? That's straight. It's the price, sell it. You don't really care, but once it's under 20%, it's just an investment for you. Okay. This one here is new. So when we have equity method, we're gonna recognize our percentage of revenue. Well, let me put it a better way. Net income, net loss, and dividends. So we don't, so every time the company reports net income, we can recognize if we have 20%, we can recognize 20%, if we have 30%, 30%, same thing with losses, same thing with dividends, right? So the questions that I had there for you to look at, they are around that. So we can do one of those questions just so you can walk it through. So we're gonna look at the 17, 12. So go to exercise 17-12 in your text, I'm gonna go to it on the screen. Okay, so here we are just preparing journal entries. So that's the other thing I would say to you when you come to the exam, make sure you have your calculator, have a ruler. I think normally here they give you a little booklet you could do the work in. So just have a ruler because it kind of helps to make your answer clear. Debit, credit, description. Okay, so here, this is exercise 17-12. They give us two situations and they ask us to prepare all the necessary entries in 2020 for both of them. So take a look at the first situation. So here, Conchita Cosmetics acquired 10% of 200,000 shares of common stock of Martinez Fashion at the cost of $13 per share on March 18th. On June 30th, Martinez declared and paid 75,000 cash dividends. On the 31st, they reported net income on 2020. At December 31, the market price was $15. So which one am I in? Which bucket? 1, 2, or 3? Over here. Okay. Which one? This exercise 17-12. So which, based on how much they hold, bucket one, because they hold less than 20%, right? Everyone is there, yeah? So they own less than 20%. So here we use the fair value method. So the first thing you have to do when you look at a scenario is say, which method? Right, so they tell us in the first one, less than 20%. Okay. So that situation one is the less than 20%. So this is the regular, we were doing investments. This is simple and what I call the simple and easy. So here we would have on the 18th of March, when they purchased it, we would, yes. So, and then we would have equity investment. And how much was it that they spent? How many shares they got?
200,000 shares. I put one of that as 20,000.
Okay, so they got 20,000 shares at what price?
$13 per share.
Okay, so 13. So they end up spending 260,000. 260,000. Okay. So that's the investment. And Martinez Fashion. Okay. The next day, June 30th. They paid us some dividends, so we got what in our hand? Yeah. And then we have dividend revenue. And how much dividends did they pay?
75,000.
And we get So if they paid 75,000, we could either divide that by 200. How much, 200,000 times, from 20,000, or we could just times it by 10%, either one works.
7,500.
Yeah. So here the dividend, was,
On page. 17. And 17 and 12. And they have 17 dash 55.
okay. So I just put this here, just a per share dividend, we have 20,000 shares, so. Good morning. Okay.
I'm gonna say zero times the 10% at 7.
That's another way to do it, but I like this way, because then this is more tied to the per share dividend, we have. 20,000 shares, so you just times it by the dividend per share, right? Either one works. Since once you show the work in, it makes sense. And then 31st of December. They tell us that. These shares that we bought for $13 now, the market price. Is 15. Okay. So under the first fair value method. We normally would do an adjustment to bring it to the fair value, since we do it under that method. So. Fair value adjustment. And then we have unrealized gain or loss. They have an explanation there, but this is the correct description, unrealized gain or loss on marketable securities. Because we consider them marketable securities. And the difference between the 15 and the 13 is $2 per share, so that's $40,000 adjustment. So this is gonna be, the price go up, so we adjusting this investment by that amount, right? So this would have normally happen, because we're not holding it. We don't have any influence, less than 10%. So that's scenario one. And this is something you would have done in previous accounting. Thoughts, right? So what is new is scenario two. So we go to situation two. Situation two. They tell us Monica Inc. obtained significant influence over sales by buying 30%. So this time they bought 30%. Of outstanding shares of common stock at $9 per share on January 1. So which of the buckets? So we in this bucket now, where we have this influence, and we have between 20 and 50%. So now we use the equity method. So under the equity method. January 1, we have. Yes, a new date, so we have. 1st of January. Yeah, 15th of June. And we got 31st of December. So that's the other thing I would say to you, when you go on exam, when you get a bunch of dates, it's good to have your paper, line it up for journal entries. And put the dates there, so it'll trigger you. I need to do some each of these dates, because sometimes people miss dates. Because especially if it's in a paragraph form. When they do an entry and forget, oh, I was supposed to do this too, and that might be connected. So I like to set it up in a way that it triggering me, I need to do something. So, on January 1 is when we purchase.
Okay.
The shares. June 15. There was a dividend. Declared and paid. And then at the end of the year, they reported net income. All right. So this equity. So notice the difference when it's the equity method, we don't care about the market price at the end, we care about if they're in income or loss. Okay. So. The first one where we purchase our shares, what should we be doing there? Anything much different than the first one? We have to pay something outright when we buy.
We're getting that for the investment.
Yeah, so this part is the same. Equity investment. And cash, and how much is this gonna be for? They told us we got 30,000. That's somebody, yeah, the total shit, or 30% of that. 30% of it. Okay, times 30%. Times $9. Okay. 81. Okay, so first entry done. So this the purchase share investment. In sales corp. So I don't know what detail there. So we had dividends that were declared. Okay, June 15. So we got anything in our hand? Then we get dividends paid in cash.
27,000. So all stuff over.
But what would the first part of entry, we getting anything in our hand?
Yeah.
Yeah. So that's the other thing I wanna say, when you have an exam, you have journal entries, which you know for sure, put that on paper in terms of the entry. Anytime they say paid in cash or you got in cash, you write that down, because that piece, you know for sure that can be right. Sometimes you don't always remember the other piece or the description, but if at least that part, get it right. Some persons will put nothing on the paper if it is imperfect. Okay, so we had, I lost my question. Okay, so we had for the 15, what was the dividend?
27,000.
Mhm. That's the total dividend, right?
Yeah.
Okay, so how much did we get? Was our percentage 30%? So how much did we get in cash?
10,800.
Okay. So the difference here in the first method, this doesn't go to dividend income. This goes to the investment. Okay, so here we have on the other side of this equity investment. And this sells corp. Okay. So under the equity method, what we do is reduce our investment in sales corp by the amount of dividend we got. Okay? Because what we're saying is that when someone pay out the dividend, they paying out capital or earnings. And all we doing is recognizing our share. So at the end of the year, sales corp reported income of 85,000. So this income, we don't get this in cash because they don't give us the income. But what we do again, we record our share of this income because that's going to go in their retained earnings. So we're going to have equity investment. Our equity investment is going to increase. So we could recognize 30% of this. Right? And this is where we recognize investment income. So 30% of that is what?
25,500.
Okay. So we made the investment, so that's basically the same under both methods, 1 and 2. We got cash for dividend, right? So under the fair value method, we have had investment income here. But this is the equity method. So we record equity investment, we reduce it by the amount of the dividend. And then at the end of the year where they report income, right? We recognize our percentage of that income. And the other side is the investment income, right? So this method is valuing our investment based on the value. This is an indirect way of valuing, showing the value based on the value of the company. Okay. So this is equity where we have 30% and we have influence. Right? So that really is the nuts and bolts there. Any, like I said, make sure you know the theory, make sure you know the definitions. So that you feel comfortable with the theory as well. Everyone there with that? So today we're going to, the rest of the time, we're gonna look at chapter 18, which is revenue recognition. And next week is the exam. Any persons who want to take it early, this when I say early, and this is only if you are traveling or have a situation where absolutely you cannot do it next Saturday. So I want everyone to do it at the same time. Let Ms. Dean know. And then we could go from there. So it's not gonna be more than 2 hours and then that's it, okay? Like I said, 40 multiple choice, and I'm gonna have, how many questions? I say 2 or 3? 2. You make sure that. 2 questions. So it's not gonna veer far from what you've had in class, right? So, like I say, just make sure you review the terminology so you're comfortable with that. Yes, yes. So, I'm gonna make sure they post this video because I know both of you came in a little later. We went through 15, 16, and then 17. That's what you walked in on. Okay. All right. So it's recorded. So, chapter 18. I would say this is more theory than entries. So chapter 15's focus is revenue recognition. So this has been a challenging thing for accountants because we have had different standards and we've had different approaches internationally and in the US with US GAAP. And so you probably would not be aware, but persons who practice in accounting all the time would know that there's a convergence that's happening. So globally, what they're trying to do is bring the US GAAP in line, and international standards to have one standard. That was supposed to happen at least 5 years ago, but still ain't there. Other countries that were using other standards like Canada converged already. So in the Bahamas, we use international financial reporting standards, IFRS, that's what we call IFRS. US, you still use US GAAP. Which is different with some approaches. So there's still this move to bring everyone globally to one standard. So this is an area where there is convergence because there are certain topics that or standards that all of us do the same thing. And one of the reasons why it's so important for everyone to do the same thing, because if I'm in Japan, if I am in London, if I'm in the Bahamas, if I'm in the United States and I have financial statements for each country, I should be able to compare them when they look the same. If you're doing something over there and I doing something over here and I compare it, I gotta figure out what you do different and then do some adjustments so that I can compare the same. And because of globalization, there are companies that have entities all over the world. And when you have an international company and you have to consolidate all those statements, if there are differences in the way you do it and I do it, you also have to reconcile that. And you have to pick one and do everybody on that one. So in many companies, even locally, they will say we use US GAAP. And then they'll say, but when we have reporting to do to the EU, we have to go to IFRS. And they'll have one set of books that they use in US GAAP. And then they'll have IFRS, which is the rest of the world. So that's a mess, right? Because it's a lot of work. So like I say, this is one area. Revenue is where we have convergence. And the reason why they wanted to do it is because they wanted a framework that was robust. So when they say framework, an approach to saying, can I recognize revenue? That's all this is about. Can I recognize revenue? And if I can, when do I do it? When does the contract start? This is what this is about. When does the contract start? And when can I say, I have revenue, right? And I can recognize it as revenue. And what this does is help us navigate and figure out where that point is. So we have this continuum where I'm the customer. And you are a vendor. Right. I'm offering a good or service or both. And I'm acquiring a good or service. So for me, because I'm the company, I have to figure out at what point when do I have a sale, right? So most people think this is really simple because a sale happens when I exchange something. But if I'm Amazon, right, and you order something online, how long it take you to get the goods? If they deliver it, if I was in the US, I can get it 24 hours now. So in 24 hours, do they record the sale when you click that button and pay? Or does that sale happen when you say, I am satisfied with the product I got, day 10? See, that's the question. Right, so I am Amazon, when do I record the sale? Right, so it's just I just post it because it's a real thing, right? I have a school that I have as a client, so that's something I'm actually contemplating now, what is the correct entry, because I don't think they were doing it right. So you pay your child tuition day one, right? So this is, let me put it this way, so this is semester. Right, so you paying for service, education. So semester this day one, this August, September, November, December. Right, next term start over here. Then you gotta pay in December. For term 2. You had to pay here before you started for term 1. Could you recognize revenue here? Yes. Did they deliver service yet? Yeah. So yeah, recognize revenue, you see? No. Because the company is the school. So the day you pay, that's a prepaid for them. Right, because it's honor and revenue. So when I get to September, and say those schools, their schools are starting in August. So a month passed, so I recognize any revenue. Yeah, so this is where we get into questions of, is there a non-refundable piece? Are there any discounts? Is there, if you pull your child out now, do they, say that you have to pay up to a certain date, right? So any type of clauses. So that's gonna impact how much you could record here. Right? So the school I have, they have a activity fee. And they said to me that fee is non-refundable. So once you pay, and some have like a development fee for the school. So once you pay that, that's it, they recognize that. Yeah. Right? You pull your child out too bad, you may get a percentage of your tuition up to that date, if they say that's the policy. But again, is you are offering good and service. So what the standard says is that we're gonna have 5 steps. So in the convergence to recognize revenue, all the persons came together and they identified 5 steps. How do we recognize a contract? We can use that same one. So 1 is identify the contract with customers. So that's the first thing we say, is there a contract? You need something that is between 2 or more, 1 or more parties, right? So I can't contract with myself, it gotta be some other party. And it has to be a situation that the rights are enforceable. And so there's rights or obligations. Right. So they have to be enforceable. And you gotta have 2 parties, 2 or more. So with the school, we have you, and then the vendor is us. So we're the company, and that's you, the customer, so we got the 2 or more. The rights have to be enforceable, some sort of valid contract exists. So this valid contract. As accountants, we gotta understand it. So if you were studying accounting and doing a degree in accounting, you'd have to do business law too. Because you have to understand what a contract look like. So one of the things you gotta have commercial substance. So it can't be something flim flam. Can't say you going to school and you paying $5. That ain't real. Right? The contract, both parties have to agree. So it have to be approved. So how do we approve a contract like that? What's one way we approve contracts? Yeah, so like you have an employment contract, you agree to give a service, the company agrees to pay you, that's the contract that we would have to recognize. If I offer services to a consultant, that's a contract for services. I have to get their signature, for me to go ahead and do it, right? So in the past, this used to be verbal. You didn't always have to have a contract. I used to work for Swiss Bank and they told me, they said, you know, we don't always have contracts in writing. And I was like, really? And they said, no, they say we shake hands and that's your word. And they talking about millions of dollars and they were serious with that, right? But in our environment, it needs to be approved. You need people to sign to make it valid. So these are the things that make it valid. Right? The contract also has to identify rights. It has to identify payment terms. And you have to know that it is probable the consideration will be collected. So this is definitely where someone says, like I have a plumber coming today, that if they do the work, I sign a contract with them, that I am going to pay them when they send the bill, right? So it gotta be a probable consideration that, probable that consideration will be collected. Consideration is what you give up in exchange for goods or services. So consideration could be $1,000 or whatever that consideration is that you're gonna get it. So the 5 steps, so the first one is that you gotta have a contract. So let's go back to the school. So how do we get a contract there? What happens? Tell me the process.
You mean during enrollment?
Like, when does the contract happen?
I mean, yeah.
Anyone have kids? Young?
That's what they feel about it. You might need something down. What you say?
Any of y'all have kids? So when did you identify? So which schools? Tell me which school.
Actually,
Oh, you're nursery. Oh, you weren't in school yet. You weren't get big school yet. Okay, so that's big school. So when your child first had to take an entrance exam, they had entrance exam, right? And then they send you a letter saying that your child has been accepted and given an offer. And you have to do something to confirm that you accepted. And you had to sign something, right? So now you got a contract. Because now you committed to bringing your child in. So that process ain't by accident. It's not just to get a number. It's to establish a contract that we are going to invest in all these resources because we have 500, 600 committed students who are coming to the school in September. So we gotta have the teachers, the building, all of that for these students, because we have a contract that we have to live up to the service to deliver education, right? So that contract has to be approved because you gotta sign it, they giving it to you, that is signed. And you have to return it signed, so that's 2 parties agree. With that, they gave you the terms and conditions, right? If they didn't, then you update that. I was talking with the one I deal with now, and they said to me, they had to put in it, because we were talking about, because this particular school, I telling them they had to go cashless. So they had to put it in the communication for school fee. So we ain't doing no payment plan, we ain't doing none of that. You gotta pay it. Or your child wouldn't be accepted, right? So that's a contract. So once you say your child come in, you gotta agree to what that says, right? The rights are identified, correct? They tell you the terms, right? They tell you the payment terms upfront, over time, over 3 months, whatever it is, you get the terms. And they assess whether you have capacity. Whether you realize it or not, they have to consider you have some ability to pay. Because if they enroll a bunch of students with parents and they know they probably cannot pay, that can be a challenge. Now, we don't go that deep in the Bahamas, but in some countries where they have private institutions, they go that deep. They ask about the parents. Who are the parents? Where do they work? If they work, if they're in business, because they're trying to figure this out. Because if I enroll a bunch of students based on the application fee, I may have a going concern issue later on to say, is my business sustainable? Because none of these people paying, right? Because it ain't good enough that on day 1, everyone come and then you have to send everyone home because they didn't pay the fee. You gotta have this idea that you can get the revenue. All right, so the next thing is the second step. So the step 2. You have to identify separate performance obligation. So this is where you have to be able to clearly say what is it that you are selling to this customer, right? So this has to be clear. You have to be clear in your obligation. So. So that's normally the terms of reference. So when I do a consultancy, I say specifically, look, refer to the schedule, this specifically, what I agree to do. This is the time frame I agree to do it, and if anything bears from this, we're gonna have a discussion to discuss new timelines of fees, right? So this gotta be clear. So with goods and services, it's kind of easy. Someone walk around your store, they pick up, say eggs. They walk up to the counter and they pay, right? And normally you'll see food stores have signs out, and they'll say these things are not refundable. Once you take eggs, you could bring these other stuff back. But they're supposed to have that clear and distinct, your terms. Right, we're not good at that in this country. We are not, I can tell you. So they're supposed to be clear, your obligation. Some will tell you the minute you leave, you on your own. They're supposed to tell you that. So if you on your own, once you leave, then you could recognize all your revenue. If you are not on your own, you have a warranty or you have any assurance, so that's when, we get into warranties and the different type of warranties, because say it's Nassau Motor, I agree to perform free service for a year or up to a certain amount of miles. So when you walk off, it might not be, I could recognize all the revenue until I did all of those things, right? That I agree is part of the sale. So that's why you have to be clear and you have to identify if there are multiple, you have to be able to identify each obligation. So if you have multiple obligations, you have to identify each one. So buying a car is a good example. It may not just be buying the car, they agree to service it. They agree to do certain things, be available on call, whatever it is, for 1 year. They not be, I know in the past, I don't know what happens now, but in the past, when you used to buy a car, they used to give you a sheet, a list of things. And they'll say, this would be, and they were very specific. We'll do an oil change, we'll do this type of service, because they were very specific. So they're saying, if you run the car hard, and you come and say, okay, you need to fix my bumper, right? They were very specific in that. So, and each product has obligation. A lot of people are, if you buy a Louis Vuitton bag 30 years ago, you come back, they will replace your bag. That is embedded in their obligation. Rolex has the same thing, but they have where it ends and where it begins. If you let someone else touch it, then they are released. So Apple, I think Apple is like that, certain companies, but they have these up. So that's very important to be able to identify what it is, because then once I know, once I satisfy that obligation, I can recognize revenue. So the third piece is determine the contract price. Or a better way, the transaction. Okay. Again, this may seem like this is obvious or simple, but not necessarily. Because this could be something that varies. Right? This could be time-based. You could have bundling that happens. So bundling is if you go and, this is the favorite thing now. So if you buy, you get a phone, you could get these other things when you get the phone, right? You get free Wi-Fi for particular thing, you get so many minutes, and that each one of those is a different revenue line. And so when that occurs, you have to be able to separate each of the different lines of revenue, right? And have a price assigned to it. It's not always simple and easy to skim that off. But there's where we have different methods to say, okay, what should I allocate to this part of the price? So let me use the school as an example. So most people, they go and they say, oh, my school fees are $4,200. So that's what it is, right? Really, that school fee is bundled into a number of things. So that 4,200 may include tuition. Now they have like a IT fee. Some schools have books included. Some have the basic like sports kit. You get 2 shirts, and then, like I said, like a development fee. So when I'm doing this person's financial statements, each one of these is a revenue line. Right? Each one of these. Revenue, revenue, revenue. You paying 4,200, but for me, each one of these is separate. And I have to report it separate, right? Sometimes it's not easy to strip out, okay. Say the IT fee, that might not be easy to strip out, but I could strip this out. These are easy to define. So whatever left over might be the IT fee, right? That's a way of looking at it. So that's step 3. Step 4. Is allocating the transaction price to separate performance obligations. Why do you think that's important to be able to do? Do they all happen at the same time? They may not. It may be that for the product I'm selling, one of the obligations might happen right away. I could service right away, and the other ones may come over a period of time. So this is a good example of vehicles. So when I get my transaction price will be the value of the vehicle, the service, and maybe they give me certain those small items could be with it. So I get to think of one. So let me do a computer. That's a better one. So I buy a MacBook. Right? So when I buy a MacBook, I am getting the laptop. So when I buy that, I can recognize that right away. So revenue, I can recognize with that right away. Right, so that might be of the MacBook might be $900, right? Now the transaction price might be $1,500. That might give me free cloud for, that might be 200 out of it. That give me insurance. might be another 200. And then I get and then I get this last 100. iTunes Music. Right? Each one of those I could buy separate. But they bundle it into 1,500, right? And so now this price, I gotta allocate it to each one of these. And it's important because these are gonna expire at different time. Once you buy the laptop, I could recognize that right away. They may give me free cloud for 3 months. So once the 3 months up, I could start, or I could divide this by 3. Insurance, maybe for a year. Right, so this I might have to divide by 12, so every month I could recognize a little piece off of it. And iTunes may just be for 1 month. Right, so each one of these, a different point revenue is gonna be recognized and in a different way. So that's why it's important to strip it away. To see all the components. And then the last piece is just recognizing revenue when or as each obligation is satisfied. So just taken from this point to here, now we say day 1 sale of this MacBook, I sold it. Day 1, I can recognize 900. Month 2, I can recognize a piece of each, and after 1 month, this whole thing, right? So this is, has the obligation been satisfied? That's the question. At every period end, has the obligation been satisfied? Is there something I can recognize? And until it's satisfied, what do I record it as? If I got it all in cash up front, unearned. If I didn't get it all up front, what will happen, and this happens with say like this, this and this, you may have to pay, you might have paid 500 down, right? So they billing you for the balance. They may have something even with this piece that you pay the whole amount for the laptop, you pay the 900, it can cost you 15. And then they put something on your credit card to hit you every month for this. Right, so you might not have unearned, because they may say for this, we can hit you every month and then it can expire and you can get a notification renew. So that's why they like that better than unearned, because they recognize in one's obligation, you already got your free month, not free, but you paid for a month. That's you stop, click, you can record revenue now. Right, and they hit your card and that's revenue right there. So as obligation is satisfied, I did my part. Now I could recognize it. So that's the final step. Now the last. So that's like, so us going through those 5 is maybe 80% of the chapter revenue recognition, whatever transactions, whatever scenarios you get, that is the first question. Has a contract or transaction taken place? If it has, how much can I recognize now? If I got all the money up front, is there any piece that is unearned? If there's something that's unearned, I have to recognize that. If it's something in progress, I can only recognize where I have satisfied the obligation. That's the key thing. So you have the 5 components to analyze whether we could recognize revenue. That's really what it is. So some other situations that I think and the book speaks on it, and I like to put it in this type of framework. And I encourage you when you study, one of the things I always tell people, if you have to go to the textbook every time and you study, you're not doing it effectively. One of the best ways to study is take notes. And if you put, and you should have one sheet of paper for every chapter. And everything that you, all the key points should be on your one page. Right? And you will find that the only thing you will put on that page is what you really don't know. The things that you know you don't need to really put on the page, you might put little things to cue you. But once you summarize it on a page and maybe the next side of it, you don't have to go back to that chapter again. And this is from summarizing entries, etc. So one of the tools, because I'm gonna use it now and talking about this, it's in tables, right? To remember things. So when we are counting, there are certain big transactions, and this is in terms of revenue recognition, we always have to be aware of. So we can only see some major revenue. So normally textbook gives you a bunch of information, they flow and they are around a particular topic. So I like to put things in tables because they concisely put the ideas together side by side. So we have these transactions. Right? And what I'm gonna put here is recognize revenue when. Okay, so that's what I put in that category, and I can put description of obligation, maybe. So the first type of thing we have is sales returns and allowances. And this is normally, we have a product, someone get it, they don't like it, they don't want it. And sometimes they could get in exchange for a refund, or they could get another product. And so we still have an obligation to them, right? Because when we sold it, we would have recognized revenue, right? And we had an obligation to them that this product can work, they could be happy. Right, because if they're happy, I think you had given us the Amazon is if you satisfied, you don't return it, right? Because they have a time too that you could return. That's why they put that time limit there. So they say this product could be returned within 1 month or 2 weeks, because once that expires, I hit my revenue now. I can recognize my revenue. So, or they could have this thing here where they recognize the whole thing, and then any sales and returns and allowances they recorded when that happens. So here, description of obligation. So you owe the customer something. So you owe them customer a product. And I put product satisfaction. So some reason they're not satisfied, so that's what you owe them. So in terms of revenue recognition or what we do, right? So a couple of things here. When we do have a return, we have to adjust the revenue that we recognize. So we recognize it before clearly. It was returned, so it's not revenue anymore. That refund
if we have to refund them money or any aspect of refund, that can be a liability, because now we owe them. Right? And we got we have something on our asset side, right? As a receivable. Just depends on the product because they gonna owe us our product back. Right? So this is a good example of an online purchase situation. Right? We ordered online. They said they're gonna give us a credit. We must return the goods, right? So we gotta adjust the revenue, cause we didn't make that sale anymore. If the person wasn't satisfied, we gonna owe them a refund. And they gonna owe us the product back. Right, so all of the three of these would be some entry that we're gonna have to put through. So we adjust that our revenue isn't as much, we owe somebody some money back, and they owe us a product, inventory or whatever it is. So a good, like, for example, here, you could think about an online purchase. But this could happen in person as well. So a second type is repurchase agreements. Right, so repurchase agreements. The company, so our company. We have obligation. To repurchase. So obligation or right. To repurchase, the asset. At a later date. So what would be an example of this? So you could have this with vehicles. So you know that, I don't know if this is popular now, but it's popular in the US, like crazy people lease vehicles, people don't buy vehicles in the US. And sometimes they have this repurchase thing that we, you pay, but it have, the company may say, I can sell it to you, not a lease situation, but not sell, but you could have this agreement where you have it and we will repurchase it back at this particular price on this date, right? So for these, there's some, so when we get into revenue recognition, we say if the repurchase price is equal to, right? Or greater than. So equal to or greater than the selling price. This transaction is a financing transaction and not a sale. Okay. So this is big because that means that if something is a financing transaction, if something is a sale, I can record revenue. If something is a financing transaction, what do I record? If I finance something, you pay me back money and I can get interest. Whether it's direct, I say it's 5% or it's imputed, because whatever the amount that you get it less for, that's really the interest. Right? So what they saying here is, don't put some on the books. It's really a refinance and you go on the revenue. So this way you really have to understand the transaction and say, what y'all doing here? Is the repurchase price, is that equal to or greater than the selling price? If it is, this transaction is a financing transaction. Right? And this ain't really a sale. Now, if it's a sale, you could recognize revenue per state. Right? And you may say, why is this a big deal? It's a big deal because if I have financial statements, I want my revenue look healthy. But if you tell me I can't record it, that can hurt me a little bit because then I can't put it on my revenue. So that's why stuff like this matters when we identify to say, yeah, you can record this revenue, or no, you can't. You also have they call bills and hold arrangements. So here you have a situation where the buyer is not ready to take possession. Let's put delivery. But takes title. And accept billing. So here revenue is recognized. This depends. On when the buyer obtains control. So what is an example of this?
So is this similar to like a layaway situation?
Maybe a little bit. I would put layaway more financing arrangement. This, I give example, I had to order a sliding door PGT. And they told me if I get manufactured and they have to do that, I gotta pay for it. Up front. So they bill me. And it's custom, so can't fit nowhere else. And so they basically, they have control of it until it lands and in my unit, right? And so really, I don't have control of that product until that is in my unit. And I now have control, whoever installed it, whatever else. They have complete control because I have title to it. Because if it comes, then it's mine. The other persons who do it, you know, people who buy cars for people, right? So you gotta pay that up front. You send that to the company in the state, Bremen or whoever it is. And they deliver that to you, but you don't have control of the vehicle. Right? And so with these, you really have to understand if there's a bill in whole. I could even put this to furniture companies here, where you pay for furniture today, they have to deliver it to you and they may say, well, we can't deliver it this week. We can deliver it in 2 weeks or whatever. We don't have no driver. You ready have title. You have your receipt to say, I bought that bed, right? That's what I'm supposed to get in my house. But they haven't delivered it to you yet. That's another, it can depend when you take control. Cause that bed could come and you're like, hey, no, it's not about, right? But you don't get control until it's in your hands. Say that's the scenario. So this definitely, I could see with furniture companies. You could have a cars, super people deliver cars. They pay for, they have all these apps now, like Car. What's the name of it? I was watching someone one where you buy the car in the vending machine. It's like a vending machine and you say what you want, color that, and they deliver it to your house. Yeah. It's a huge company and more people doing it too in the States now. And you could trade in your cars now like that. They come, they pick it up. And you put in all the information, your VIN, what they call it, the report on it. It's incredible what they do now. So 4 is principal. Agent relationships. So here, the principal is the one who actually provides the service or product. So they're the one who doing that. And the agent is bringing the principal and the buyer together. So they bring principal and buyer. Or better customer. Okay. So the principal for them revenue is recognized when obligation satisfied. So whatever it is they're supposed to do, when that part is done, so whether it's a product or service, so if they're supposed to clean your yard, give you insurance coverage, whatever it is, when that's satisfied, then that's when they could recognize revenue. The agent now, for them, revenue is recognized when they receive their commission. Okay. So the agent can't recognize it here where the principal recognizes it. They recognize it when they receive their commission. So their role is just to bring these two people together, which they get the commission for. And whatever their contracts say to do that. And then this principal is gonna recognize revenue once the obligation is satisfied. So if they bring in you a product or whatever it is, that's what happens. So we have a lot of situations like that. Even I could use vehicles where someone go and get the car for you, right? And there's a commission you may get, and it may be a Bremen. They have a Bahamian rep who's not the employee, they just an agent for Bremen. And they bring the people together. This person wanted a BMW. This is once that person, they put those two people together, that person pays for the BMW. This person gonna get the commission, they can recognize revenue right then. This person only can recognize it when the customer is satisfied. So when that car is delivered, if they don't deliver it or something happen, this person already out the picture because they recognize it when they get their commission. Right? So we have a lot of situations, insurance, anywhere where there's someone who bring the buy and seller together. Right, who acts in that capacity. The other one is consignment. So consignments, they operate the same way as this one, like a principal agent relationship, so we could put those two in the bucket. So everyone knows how consignment sales work. So if I have a store, and this is very common in Bahamas, I didn't realize how common it was, but. So if you go on John Bull and you're a vendor, and you produce straw bags. Coles and Nassau actually does this, and I want Coles and Nassau to sell my bags. They do it on a consignment basis, they don't buy it from me. So they are acting as an agent, right? So they bring in a buyer who coming into their store, and you're the principal, you own the bags. And so every time a sale is made, they can get a commission and they can recognize it. You and the buyer, in terms of product satisfaction, that's where they're going between you and the buyer, because it's consignment, right? So it's the same principle with consignment sales. The last two we have here. The next one is warranties. So we talked about warranties a little bit before. Here it depends on if it's a service type. Or a assurance type. Okay. So for the service type, there's a separate, any revenue from this is separated, so that's a separate obligation. Whereas assurance type, this is tied to the sale. All right. So this one is tied to the sale. So part of the sale, there's an obligation embedded in it that this can work for 3 months. The service type is not tied to the sale. So this is more like what we call an auxiliary. So the service type, assurance type, and these are warranties. So depending on the type of warranty will dictate when we have revenue, right? So this assurance type, the revenue here is tied to the actual sales. So when you recognize the sale, and we had I think we had some in the chapter with assurance, with warranties and how warranties work. So you could go back to that because I think that explains it really well. But the important thing here is to know that different types of obligations that could happen depending on the type of warranty. And then the last thing we have is non-refundable upfront fees. So non-refundable upfront fees, so you would be accustomed to these, like they'll say, if you get this washing machine, we normally charge $150 setup, right? That goes with this machine. Or to activate it or whatever it is. So these are non-refundable upfront fees. And so with these type of fees that we charge a customer in terms of recognizing them as revenue, they should be allocated, that revenue should be allocated over the period benefited, so if you selling a good or service, so if it's I'm trying to think of one that would be good, so let's use a laptop. So if there's any upfront fee and we expect you to get benefit out of this for at least 2 or 3 years, then that will be allocated over that period where you expect to get the benefit from that the customer's gonna get the benefit from that service or the product. So this summarizes some of the types of transactions you could see outside of the normal. I walk in the store, I buy something, I got a dress, I gave you money, I have a transaction, right? And that receipt is evidence that I agreed to the terms and conditions of this. I was aware because, you know, even on receipts, they tell you this is non-refundable, that this is purchased on sale, all those things. That's because someone sued someone to pieces and say, I was not aware, right? So all that's there from the foods to everyone, they have everything disclosed. And so even for the accounting, when you look at it, okay, I know how to record it. This non-refundable, this is sale, I can't bring it back. But this gives you all the other types of scenarios that could happen. This is not exhaustive. Because you have, and in your appendices for this chapter, it talks about construction in progress, which is a whole topic. So construction normally could take a year or 2 or 3 years when you see them building these towers. So there's specific guidance specifically for construction, right? For revenue. So when you recognizing revenue for construction, there's specific just for that because it could be complicated. Because what they have different methods and they sometimes do it based on the cost. Sometimes they base it on a fee schedule that has been set up when the contract starts. Sometimes it's based on sales. So some projects, say if it's a condominium project, they already say for each condominium that's sold, this is the cost attached to it if they have pre-sales, right? So there, like I said, there's a whole body of information on that. So they have in appendices to give you a flavor of what that is about, but these are some big categories of what you would normally see. So that's where we're gonna end for chapter 18. That's basically what chapter 18 is about, revenue recognition. First, the 5 steps, which we discussed, and then these are some types of transactions that cover all the broad categories of what you may see. So most transactions, you could drop into one of these buckets in terms of how do I recognize revenue? And which one has the best application. So next week is the exam. And once you come, you'll be able to start. I have allocated 2 hours. You're probably not gonna need all that time, but I allocated that, so 40 questions, 2 problems. Yeah. And all the solutions should be posted.
Another review on Monday.
No, I don't need to do it. I did it today. Yeah, I don't need to do it. I'll put a message that that don't need to happen because I did it in the first part of this class. Because I wanted to avoid having any extra. That kind of puts everybody out when you have an extra thing to do. Any other question?
How will they send it? How will they send the recording or you're gonna listen?
I'm gonna go there right now to make sure it's done, right? Because I know that could be